On January 1st, 2026, the government quietly changed the rules on your retirement savings. No announcement, no warning, no explanation on the evening news. They just did it. And if you're not paying attention, it's going to cost you almost $2,000 more in taxes this year alone. But here's what's wild. Buried in the same law, there's a loophole that almost nobody knows about. And right now, the mortgage market just cracked open a window that can hand you that money right back. Welcome back to Finance Deep Dive. Let me show you what I found. So here's what happened and why you should be angry about it. A law called the Secure Act 2.0 went into effect this year, and buried inside it is a section that changes how Americans save for retirement. If you earned over $150,000 last year, which sounds like a lot, but in cities like New York, San Francisco, or LA, that's a teacher married to a firefighter. The government now calls you a, quote, high earner. And here's what that label costs you. If you're 50 or older, you've been putting an extra $8,000 a year into your 401k, catch-up contributions. That money used to go in pre-tax, meaning it lowered your tax bill. You kept more of your paycheck. Simple. The government just took that away. Starting this year, that $8,000 must be Roth, after tax. You pay taxes on it now before it goes into your retirement account. If you're in the 24% tax bracket, that's $1,920 in extra taxes that you did not owe last year for doing nothing differently, just saving for your own retirement the way you've been doing it for years. And here's what gets me. They didn't send you a letter. Your employer probably didn't explain it. Your HR department might not even understand it yet. You're just going to see a smaller paycheck and wonder what happened. But I kept digging, because buried in the same exact law, there's something they didn't advertise. If you are between 60 and 63 years old right now, you have a window that has never existed before. It's called the super catch-up. Instead of $8,000, your limit is $11,250. Combined with the regular limit, you can put $35,750 into your 401k this year. Yes, it's Roth. Yes, you pay tax now, but that money, every single dollar of it, grows tax-free for the rest of your life. If you're 60 to 63 and you don't know about this, you're leaving a fortune on the table. Now here's where it gets interesting, because right now, the mortgage market is doing something it hasn't done in 2 years. As of early March 2026, the 30-year fixed has dropped to 6.05%. Some lenders are hitting 5.99%. If you bought your home in 2023, 2024, or 2025, you probably locked in at 7.5%, maybe 8%. Do you know what that difference means? A $400,000 mortgage refinanced from 7.5 to 5.99 saves you about $400 a month. That's $4,800 a year. Remember that $1,920 in extra taxes from the Roth trap? Your refi just paid for it, twice. You're coming out ahead. And one more thing, this is the part that ties it all together. The One Big Beautiful Bill Act just raised the SALT deduction cap, state and local tax. It jumped from $10,000 to $40,000. If you live in California, New York, New Jersey, or Texas, this is huge for you. A lot of you stopped itemizing years ago because the 10K cap made it pointless. Run your numbers again for 2026. With the 40K cap, itemizing could save you another $5,000 or more. So, let me put this together for you. The government made your retirement savings more expensive. That's the bad news. But a 5.99 refi can put $4,800 a year back in your pocket. The new SALT cap can save you thousands more. And if you're 60 to 63, the super catch-up is the biggest retirement window you've ever had. They buried the bad news. They also buried the escape routes. Now you know both. If this just saved you money, hit that like button. Drop a comment if you're planning to refinance or if you're in that 60 to 63 window. And if you're not subscribed to Finance Deep Dive, hit subscribe and turn on that bell so you don't miss these moves.